Good afternoon, everyone, and welcome to the online Geneva Trade and Development Workshop, which is a seminar series jointly organized by CEPR, the Geneva School of Economics and Management, the Graduate Institute in Geneva, the World Trade Organization, and UNTAD. For today's seminar, I'm delighted to introduce to you Mary Amiti from the Federal Reserve in New York, who will be presenting her paper, The Effect of the U.S. China Trade War on U.S. Investment. Many of you are already familiar with the format of the series, but let me briefly summarize it, the main features to the newcomers. The presentation will last around 1 hour, and it will be followed by a Q&A session where you will be able to raise your hand, unmute yourself, and ask your questions directly to Mary. During the presentation, however, we ask you to keep mute, but you can ask all clarifying questions through the Q&A window at the bottom of the screen. With the help of my co-hosting colleagues, we will relay them to Mary so that she can address your clarifying questions during the presentation. So without further ado, Mary, the floor is yours for an hour.
Okay, thank you very much. Thank you for inviting me. It's a pleasure to be here. I wish I could be there in person, but hopefully that will happen soon with the, especially with the new vaccine. This is joint work with Sang-Hoon Kong and David Weinstein. And I have to start with the usual disclaimer that the views don't necessarily represent those of the Federal Reserve Bank. So the question we want to address is to look at how the U.S.-China trade war affected U.S. aggregate investment. But I should say we're actually in the process of completely revamping the whole paper. So some of the results, well, actually a lot of the material will be new, but unfortunately wasn't completely ready for distribution. But I just want to mention that one of the major innovations that we're working on is to look at the effects on aggregate welfare and distributional effects, where we would put this in a specific factors model, where we believe that excuse me, that the specific factor assumption for capital not being able to move from sector to sector is an important feature that drives the losses to firms. So, you know, for example, you have that, you know, firms might have made, you know, China-specific investments in, you know, supply chains or logistics that, you know, aren't easily transferable to other areas. But for today, we're just going to focus on the investment side. So, you know, the question we want to look at is how the trade war affects aggregate investment. So a major challenge in this kind of analysis is how to get at the aggregate effects. So, you know, the standard methodologies that we rely on, like differences in differences, you know, tell us about the relative effects, but they don't tell us about what the total effect is. And I'm sure most of you in the audience have, you know, had the, you know, the experience where you're presenting a seminar where you want to look at what, you know, what effect some policy has on some outcome variable, and you come up with, you know, a cool strategy to, you know, the identification to get through some heterogeneity, and, you know, you get the coefficients coming out as expected and significance, and then, you know, somebody in the audience says, yeah, but what can you tell us about the aggregate effects? This is just a relative effect. You know, what are the general equilibrium effects? And, you know, you'd love to have an answer to that. And you know, try to say, well, you know, maybe we can assume that the untreated have zero effect. But, you know, we kind of run into problems with that. And then, you know, of course, you can turn to calibration, but then that has its own set of issues in terms of, you know, borrowing parameters from, one study or another. So what do we do? So we're going to use the fact that unanticipated trade war announcements move both aggregate and differential stock returns in order to identify the effect of the trade announcements on all firms. And what we're going to do is embed these estimates into a Q theory of investment model that will map these effects on market value and then into investment rates. And by doing that, we're going to be able to exactly decompose the event's impact on stock price movements into these two effects. One is the common effect. So this is the effect that the trade war could have on all firms through variables that just matter in general on those days. And then, we'll also look at the differential effect, and this is kind of more like the difference in difference components that we get, that those firms that are directly impacted could have a bigger effect. In terms of the theoretical contribution, we're going to, for the methodology, we're going to integrate event studies into factor models, the event moves aggregate returns, as I mentioned, by affecting firms through the event's impact on the common factors, but also differentially for treated and untreated. And then we're going to show how we can take those impacts from the event studies on stock prices into an investment. So the sequence is that the event is going to affect the stock returns, then the stock returns imply some changes to the returns to capital, affecting the market to book value, and then those changes in returns to capital are going to affect investment rates. And there'll be two key parameters that look at the link from stock price movements to market to book, and then from market to book to investment rates. So just to give you a preview of the results, so what we find is that the U.S. China trade war during 2019 lowered U.S. aggregate equity prices by 8.3%. And if we decompose that, we find that 2.4 percentage points of that are due to this common effect. So that's how the event affects the returns in general. And these are movements that can't be explained by movements due to non-trade war related economic news. This is due to the trade war, but affecting the general component. And then we have the differential effect. So this is the additional effect on the treated firms. And I'm going to say a lot more about how we define the treatment. But just broadly speaking, it's going to be firms that import from U.S. firms that import from China, export to China, or have sales in China through affiliates. And then we're going to see how then that feeds into aggregate investment. And what we find is that by the end of the fourth quarter of 2020, that this trade war lowered investment by 3.7%. And of that fall, 1/3 is due to the common effect. So if we were to do just a standard difference in difference, that's the amount that we would miss out on in terms of knowing for the aggregate effect. In terms of the related literature, so there is we're actually broadly related to many different literatures. In terms of the event study, there are a bunch of event studies. Huang also is on the China trade war, but these studies are essentially just looking at those relative effects, whereas we're going to look at the aggregate effects. And then in order to look at the aggregate effects, we are building on a few different literatures, including the factor model, which we start with. Also the micro data to identify the general equilibrium parameters, and the Q theory models that we're going to use. Okay, pause for a second. So let me.
Mary, maybe a quick question.
Yeah.
So the general equilibrium effects here, so you're aggregating, but when you are, and maybe it will become clear and you just push it to the theory as soon as you go into this, but when you're affecting the investment rates, you're going to be affecting the demand for investment, and therefore you're going to be reducing in equilibrium the returns to capital. Are these effects gonna, you seem to stop at the final decline in investment, but in general equilibrium, there will be this movement along the supply of capital, of loanable funds. Is that also part of what you're trying to capture here?
Yeah, so I think it will be clearer in the when I go through the theory in terms of exactly how the link is going to be. But the main link is coming through the effect. It could affect the returns exactly, and then that would come through. But usually, what we would have, we'd be able to say how it affects the firms that were treated relative to the untreated. But there could be broader effects, not just on those ones that are directly treated, and this is what we're going to capture with the common effect. Okay, so first of all, let me start with the factor models. Now, so I was not, being a trade economist, I was not familiar with factor models. Let me say we're not innovating here at all. This is just a plain vanilla factor model, but I'm going to assume a lot of you are not familiar with them, as I wasn't. So let me just take you through it. But as I say, there's no innovation from our side here. We're just taking what the standard approach is. So essentially, you can, so R here is the percentage change in the share price of a firm on day T. And and this can be decomposed into what is referred to as common factors. So this is not the common effect that I was talking about. This will feed into the common effect, but these are the common factors in a standard factor model. And then there's this idiosyncratic, firm time specific effect left over. So, so in terms of the factors, there are a number of approaches. Some approaches like the CAP-M approach just, says, okay, I know what the factor is, it's the average stock return, and, they go with that one factor, and that's their delta. Other approaches, like the one we're going to use, is that we're going to say we don't know what the factor is, and we don't know how many factors there should be. So we're just going to use, based on a paper by and Eng in terms of getting the selection criteria, to work out how many deltas there should be. They're the factors. And as you see, these don't have an F subscript. So these are delta KT, and K is just the number of factors. So in terms of determining the factor, as the number of days goes to infinity, you want the variance to be positive. So, and you want it to explain a non-trivial share of for it to be a factor. So so things like trade war events, we have a finite number, so they're not going to be this condition is not going to be held, so they're not going to be part of the factors. So using the selection criteria, we end up with about three factors. The other thing to note is that these betas, these are the factor loading. So even though there might be, the factor is general, right? Because there's no F subscript. So it could be, change in expected growth rates or something like that. The response from firms, this could be firm specific. So you see that this beta has an F on it. And then alpha F is just the long run return to the firm, and that's very, very small and doesn't play a big role. And this EFT, this is, as I said, the idiosyncratic or abnormal return, and this is what we're going to use as our dependent variable when we go into the event study. So it'll be like a two-stage process. Now, so we have these factor loadings, but we need to make one more adjustment, and this is something that we do that is new, is that, you know, there may still be concern that on that day of the trade announcement, that maybe, you know, we want to be careful about attributing everything to it. Like it may be that today, you know, Trump announces he's going to impose, you know, 25% tariffs, but maybe on that same day, you know, the Fed announces monetary policy. And so we don't, you know, we want to be careful about attributing everything that happened that day to the trade war. So what we do is to ensure that we don't do that, we take these loadings and we orthogonalize them by taking, we've got 65 economic surprise variables. So a surprise, economic surprise variable is basically just any release that comes out that day, like it could be CPI, and it's the difference from that, what the actual release of the CPI is relative to the consensus forecast. So that's your surprise variable. And so we basically included every surprise variable that we could find that, you know, that and these are kind of the ones that are used like at the Fed, you know, by, you know, the Citi or Goldman Sachs, or, you know, all those kind of organizations that do nowcasting, etc. And also a bunch of monetary policy surprise variables as well. So once we do that, so then we difference that out. So then we're left with this orthogonalized delta that is going to be part of our that will be part of the common effect. Okay, so let me turn now to the stock market events. Okay, so we've got our epsilons now after we've taken out all the you know, out the loadings. And what we're going to do is, first of all, we're going to define this D variable, which is an indicator that is equal to 1 if the day falls, you know, within a window of the event. So I'm going to explain in detail very soon how we choose the announcement dates, because that's not ex ante, obviously. It took us a while to get to where we are now, and as I said, this part's completely different from the way we did it in the paper. And if you looked at the paper, but you know, so there's some announcement. You know, let's say we know the date of the announcement. So then D, we're going to use three-day windows. So we'll look at D will be 1 for the day before the announcement, the day of the announcement, and the day after. We experiment with shorter and longer windows as well, but our baseline is 3, and the reason we chose 3 days is because that's what is standard in the literature. So we're just following that. And so then, so that's the D, and then what are the Zs? Well, the Zs are the treatment. So here, this is kind of, so this structure is kind of similar to a factor model, but but the Zs are now they're not going to be estimated. We're going to say we know which firms are treated. So Z is going to be 1 if we think that this firm is treated, and we're going to have a number of different treatment variables, which, as I'll explain in detail. But it'll be, you know, it'll equal 1 for if you're an importer from China, or then we'll have like an importer dummy, we'll have an exporter dummy, and a couple of others that I'll mention. And so what we're interested in is estimating these gammas. And then the other thing to note is that these gammas, they can be different for each for each event and each indicator. So we're not just going to get one average effect for all treated firms. We're going to have a separate one for each of them. And so an advantage of that is that if we by mistake include an event that doesn't really matter. It doesn't matter for our results because we're not constraining all of them to be the same variable. And as I mentioned earlier, you know, the trade war is not going to be part of the deltas in the factor model because it wouldn't satisfy that condition that we had that this would have to be, you know, positive. It's just because we just have a finite number of events. We'll have 11 events altogether. So just one more point I want to make here is that there, again, to try and avoid confounding factors, we exclude from this estimation, from this particular regression, any firm that has an earnings report around the event date, because sometimes people think that you know, a firm having an earnings report can move its stock markets. It doesn't really matter for the results, but you know, this was raised by someone, and so we wanted to make sure that we control for everything we need to. Okay, so now let's go
Mary,
to
Mary, if you don't mind, I have a few questions.
Okay.
The first one by Veronica, who asks, when you orthogonize other potential co-founding effects, for example, policy innovations, how do you distinguish effects that are themselves consequences of the trade war, for example, monetary policy responses to the trade war, directly or indirectly?
So it's the surprise element of it. So if like today there's a trade war announcement and there's a monetary policy announcement, anything due to the so we take out of this delta any part that's due to the monetary policy announcement. So we see them as like separate events. But they just happen to be on the same day. So I don't think we can. Right, so I think Veronica's saying, what if that maybe Trump tried to coordinate with the monetary policy announcement? Is that?
No, I think the question is maybe the monetary policy surprise is itself a response to the tariff. I think that's the question, but maybe.
Right, yeah, I mean, that would have to be on the same day. So like if the announcement's unanticipated and the surprise is unanticipated, I don't think we can argue that.
I see.
Was there another question?
Yes, there was one which is very general, and I should have asked earlier from Simeon, is why do we want to use microdata when the question is a macro question? You're looking at aggregate investment.
Well, just because we think that that's a good way to actually identify the aggregate effect. So it's a methodology that's been used by others like, you know, Nakamura and Steinson, where you use very high frequency events. It's kind of like using very high frequency events to get at that constant in the diff and diff that you really want to know, like what that common effect is. So when you have, you know, very high frequency, you know, microdata, that's a methodology that you can use to get at the aggregate. So
thank you.
Yeah. So I think I was up to here. Yeah. Okay, so so then what we can do is decompose the firm stock movements into these components here. So we've got the factor model, the event study. So now so RF, as I said, is this is just the daily return, the stock price return for each firm. And as I just showed, we would get a common factor. We want to get the common factor. Sorry, I'll try to avoid getting my jargon mixed up with factors and effects. So this is the common effect, and this is the differential effect, and then this is just an idiosyncratic. You know, it's just something that's unrelated to anything else, but just affects the firm on that day. So this common effect is the additional thing that we're interested in. So as I pointed out, so this has two components to it. as I mentioned earlier, these deltas multiplied by their loadings come from the factor model, and this was the common factor. But as I said, it goes into the common effect, but it's not the only part. There's also this additional part. So this is kind of what the what the factor model would predict as the effect on that day. Right, because this is T, after we orthogonalized it for the economic surprises, etc. But then there's this additional theta T, which was here, from the event study, and this is the average effect on that day that affects those firms due to. Due to the trade announcement. So the sum of those two combined gives us what the common effect is on that day. And then the differential effect is, again, in the standard way. So this is going back here, we estimate like how the treated firms are affected differentially to the untreated on those days for each event. So that gives us the two components that we're interested in, and together the RC and the RD is the aggregate event effect for each firm. And then we can then easily aggregate those to the annual level if we want to whatever T is. It could be the day, or going from the firm level to just by using the firm's weights to get to those, and we can weight each component. Now this is important for the study because when we go to the investment part, the investment is at the quarterly level. So we can also aggregate these to the quarterly level, so then we can see how it links to the to investment. And so we have these the main ones that we're interested in is the common and the differential. That's what we attribute to the trade war. But then you also have like just the average returns, the average long run returns, and then the idiosyncratic effect as well. Okay, so just one more little bits about the theory, and then we'll go straight into the data. So this is now how we go from the stock prices to investment. So this was relating to Marcelo's question. Again, here we're just taking a standard Q theory, a model. This is not new, so you have the IK. Our notation S is quarter because we'd used T for days earlier. So S is the quarter, and K is the firm's initial capital stock. This is the firm's depreciation, row F, and this is the price of investment goods. So what's important here is the size. And then V to K is the market to book value. Now the size are important in that if there's zero, I mean we expect them to be somewhere between 0 and infinity. But let's say if they're infinity, let's say what you end up having is that the investment is just going to be replaced exactly by the depreciation rate. So that's a fixed capital model that there's no growth. The adjustment costs are infinite, and if there's 0, then you have a perfectly mobile model, and then you're just going to set the marginal benefit equals to the marginal cost of adjusting capital. So what we find is that it is somewhere in between, and our estimate of this is just very consistent with the literature. But what we're interested in is then, how the trade war event affected this market's book value, and then this tells you then how it affects investment. And to do that, we just totally differentiate the investment equation, and then we want to get to see what these lambdas are, which is the response of each of those different components of the share price movements. And then we're just going to aggregate and across these to get to our aggregate effect. But let me turn to the data. All right, so I'm going to start off with just with this chart to kind of set what we're talking about, what we're interested here. So the first thing is, how do we select our event dates? Now, in the paper, the way we had previously done it was that we looked for Google Trend searches, peaks of Google Trend searches for the word trade war. And then, we said, okay, if it crossed this threshold, we would call these announcement events. So, so we did get some criticism of that approach. I mean, we were trying to be objective in selecting the events, but, some people were like, well, why did you choose this cutoff instead of that cutoff? So then we decided, we would go to this new method that, we haven't written up yet, but this is what we have in the slides, is that we said, okay, let's go and find all the dates. So first of all, let's just look at the U.S. tariffs, all the dates that we had new tariffs, and then we will go back and find the first earliest announcement of that tariff. So these are the implementation dates of each of the tariff. And as you see, the tariff started off at like 1.7%, 1.6, and then ended up, about 5.5 by the end of 2019. So the first announcement was on the solar and washing machines. That didn't only apply to China, but other countries as well. So that would be the first implementation. So then we went back and said, okay, when was the first time there was any announcement of this? And then that counts. And what we found was that was on the 22nd of January as the very first announcement. And then we said, okay, what's the next one? So here we have two steel and aluminium, but this second one is about the EU and other countries. It was only the first one that was about included China. So that's the event that we want to find the first announcement date. And then the first China-specific tariffs were imposed in July and September. This was one tranche that was announced as a $50 billion. It was tariffs of 25% on $50 billion of imports. And then, so what we did was we found the first date that was announced. So even though this is in two tranches, this will just be one event the first time it was announced, and so on. And then we have the same, I don't have a chart, but we have the same thing for the China retaliation. We find when China imposed tariffs on US exports, and then we find the very first dates. And as you see, like US announces, China retaliates, US announces, China retaliates, it's kind of like a tit for tat type thing. And so these are the returns on those days. So on average, the market fell, about 10% on those days. In total. And then this is when we do the 3-day window of looking the day before and the day after. And as you see here, we thought that there might be some bounce back, but if anything, the effect is a little bit stronger. And even when we go to 5 days, it's still over 10% fall.
Mary, if I can, I have a couple of questions on the announcement. Monica is asking me whether the official announcement, whether these are official announcements.
No.
Or they are okay.
No, they're not. They're not official announcements. I mean, if the official announcement was the first time we heard about it, then that would be the date. But it might be it appeared on Reuters or Bloomberg or Wall Street Journal, or so we went back looking using Factiva and Google News, and we had two independent. We had our research assistant and librarian at the Fed going through finding what was the first date. That they now, because that's when the news. So it's not the implementation date or the official announcement. It's when the market hears the news, and it's not just like threats and tweets and I might do this. I'm going to have imports on every single good. It's it's a news announcement with some content that we.
Okay, thank you. I also have a couple of questions going back to the methodology. One is by Julia, who asks, how should we think about the untreated firms? Which are these firms?
Okay, you'll have to hold off from that because I've got quite a few slides on that.
Perfect. And then, so we hold for that. And then another one from Richard. How do you let the dampen investment to feed back to GDP growth in the medium run? And then can this feedback to the book value of the affected firms via future sales?
So not explicitly, but like as I said, we're going to instrument for we were doing IV, but we don't actually do IV now. I might get back to that one as well, if that's okay.
Okay, perfect.
Okay. All right, so let me talk about the firm selection. So first of all, our sample consists of firms, of all listed firms that we have on the CRISP data from 2016 to 2019 is the daily, or for all trading days that we estimate the factor model of. And so then what we do is we identify the production networks. So what we want to look at is we want to identify all the subsidiaries of each firm merging these data sets. Because, for example, Apple may not necessarily import directly from China, but it has a subsidiary, Beats Electronics, which does import from China. So then, we would want to count, say that Apple is a treated firm. And then we also look at the principal suppliers from FactSet. So, so Apple, gets, so Foxconn is one of main suppliers. So again, we want to make sure that we get all those linkages. So what are the treated? Okay, so this is an important question, but I thought it deserved a couple of slides rather than just a couple of sentences. So we want to identify, first of all, we want to identify the firms that import from China. So we use the data mine data for 2017 to identify firms that import or export from China, and we use the firm names to merge with our CRISP data. Now, these data have only information on seaborne trade, and it's by firm, country, and HS6 category. The problem is that because it's seaborne, that there are some, there is a lot of trade also by air, which it would miss out. So there are two problems. One is, like, even though they say it's by HS6 category, in practice a lot of them are HS2. So we couldn't really use the industry dimension. So for this, we just used, as an indicator variable, whether you're an importer or exporter from China. And then there's the seaborne, as I said, for the seaborne trade, it accounts for 62% of the US imports from China and 58% of the exports. So there may be some importers and exporters that we would miss out if we were just to use this dummy. So in addition, we also use in FactSet for the exporter side, there's a variable that tells you the share of the firm's revenue that comes from China. So that share of revenue does include both revenue as well as affiliate sales. I mean, we can't separate the two, so we just include we include that variable as a share variable. Again, we're still concerned that we might have missed out on some importers. So what we do is we also include a dummy for large firms. So that would be a firm that has more than 1,000 employees. And this is just drawn from the literature that documents that large firms are the ones that are likely to be the importers and exporters. We do robustness with and without the large dummy, so you can see that it's not that dummy that's driving everything, but you know, we also include it for our baseline. So what does this data look like? So we have, you know, as I said, like if you just look at the firms that import from China from the data mine data, you get the 11% of the firms in the CRIS data are importing. Once we add their subsidiaries, the imports, their subsidiaries, then we this more than doubles. Then you get 26%. Adding their suppliers increases a little bit, but the big increase comes from you know, including their subsidiaries. The average of the share of firms that have more than 1,000 employees is 60% in the sample. And then looking at the export side, we have firms that export to China. That's about 2%. And then if we add the subsidiaries, that increases to 5%. But once we look at the firms that have positive revenue share, and as I said, this might be from exporting or revenue, then that goes to 40%. So, you know, so on average, firms that are exposed through imports or exports, 51%. If we add in the large dummy, then we get 70. So 70% would be treated firms, and the other firms would be untreated. And then, you know, large firms are more exposed. You know, I just want to, from this, just to say that, you know, if you look at the top 100 firms, they account for 56% of the market capitalization. And for those, for the top 100, the average China revenue share is about 6%. So, you know, so this variable turns out to be important. Okay, so let me turn to the estimation. So, so we use, so as I said, you know, there are different approaches and how many factors you get. So here I just wanted to show you, so every time you add a factor, you're adding 2,605 parameters. So, you know, one for each firm. You know, the first factor accounts for most of the variance. It's 10.6% variance. And then as you keep adding factors, you get a lower addition of the variables. And as I said, just using the Bai and Eng approach, that indicates we should have 3 factors, but we do some robustness for that. And then, you know, if you want to see what, you know, the summary stats of what a factor looks like. So this is the first the betas for the first factor, the loadings. And what you see is that, you know, the distribution is, you know, the median is about 1. I mean, so because it's telling you how the first factor would be telling you how that firm responds, the effect on that firm relative to the aggregate market. And then I think I mentioned earlier that alpha F is the long run factor, which are, you know, very, very small. That's just the firm's average over the whole period. Okay, so let's have a look at the dispersion of the returns. So these are comparing the treated and the untreated. And in the first row, we don't put the large firms in the exposed, and then we include them here in the second row, just again so you can see that it's not just the large dummy that's driving everything. And so what you see on the US, these are the US tariff events. You see that, you know, the average, the cumulative abnormal returns for the treated are, you know, to the left of the untreated. You also see that a little bit on the China tariff events, but not as big a shift as you do on the US tariff events. Okay, so let me now turn to the US tariff events. So we've done the factor model now. We've got our abnormal returns. That's our epsilon, and we want to estimate this equation. And so what I want to, so here I'm just showing the US tariff events, but what I want to emphasize is that this is actually just one regression that goes over to the next page, which is for the China events. So I've just put them in columns just to highlight, for each separate day. But as I said, we have like these gammas. We're not imposing the same for each day. Here we just report, column 1, we're just reporting the average over, this is just the average of the US events, but it's not a separate, this is not a regression, it's just taking the average of these. So the regression goes, across all of these columns, and we have a separate coefficient for each one. But just for ease of exposition, we can look at just the average numbers so that we get a sense of what's happening. So what we're interested in is to see what these gammas are. And so here we have 6 US event dates, and then we have another 5 China event dates. So we have 11 events, and for each of those we have a 3-day window: the day before, the day of, and the day after. So that's the regression, and then we have this theta t that's going to go into our common factor, the common effect. Sorry. Okay, so what we see is that on the days of the US tariff announcements, that China importers, and remember the large dummy, we think, or proxies also for the missing importer dummy, is negative and significant. But what we see is that the exporter and China revenue share is also negative and significant, and this could be due to some anticipation effects. Is that when the US announces that it's going to hit China with a tariff, probably the exporters are thinking, okay, we're also going to get hits, pretty soon. So then we do a decomposition of these effects, and so on the days of the US tariff events, the market fell by 5.7%, and what we estimate is that the differential effect is 4.7. For these, the common effect, this is close to 0, and then the rest of it is some idiosyncratic effects that have nothing to do with the trade war, and also not predicted by the factor model. So here we have this differential effect of 4.7, but then when we go to the China tariff events, so what we see here, again, these columns 2 to 6 are part of the same regression, with the N being 73,000, which I didn't report here, sorry. So what you see here is that on the importer side, on average, you don't get much happening on the importer side for the China retaliation, but you do see a lot of action on the exporter side, both for the exporter and the China revenue share. And here you do get like a bigger common effect. So on the days of the China announcements, the China retaliation, the market fell nearly 6%, and about 2.8 of that is due to the common effect, and 1.1 due to the differential. So the total event effect is 3.97. But importantly, we're not attributing everything to the event. There are movements on that day that have nothing to do with of the trade war. Just could be just to some idiosyncratic factors. So we do some robustness tests. So one question that I'm sure has sprung to your minds is that what about the firms that are import competing and are being protected by these tariffs? Shouldn't we see some positive effects of some firms? So we were trying to work out how to deal with that. I mean, how to account for that. So what we did is that in column 1, we included a dummy for any industry that was hit by a tariff on the importing side. And what you find is that you really don't get anything here going on. But and then this is very similar to, I believe, Peter Egger has a paper that also didn't find any effects for the import competing firms. In columns 2 and 3 for the US and China events, what we did was we omitted the large dummy just to show you that it's not the large dummy that's driving everything. So here you see that once we drop the large company dummy, the China importer gets a lot bigger and more significant, more than doubles in size. Whereas these, well, this one, I guess it might be picking up a little bit here as well. This gets a little bigger. But mostly you see like this big effect. And then a very, I think, important robustness is this column 4. You might be concerned that these, what we're calling treatment variables, may just be spuriously correlated on those days. So what we did for our placebo is that we took all the event dates from all the training days from 2016 to 2019 and just omitted our actual event dates. And we just randomly drew 11 events and then just regressed them on our variables. And we did this 100 times. And, as you see, you don't get anything. Everything's insignificant here. So, so that kind of adds some confidence, I think, that, these are actually picking up something meaningful. And then this robustness test, I mentioned earlier that we look at different factors, the standard CAP-M and also the 5-factor model. And we don't, the results are very similar. Okay, so let me turn now to the investment. So what we wanted to do was just start off with just a standard IK specification that's to benchmark it against the literature, and our analysis is going to be in changes, because the way the event study is and the factor model is set up, the return to firms is a percentage change. So, but just to make sure that the changes, doing it in changes is not driving anything. So we first start off in column 1 with just regressing the IK in levels on the lagged market to book value, and we get this positive significant coefficient. And then, as in the literature, it's argued that you should also control for cash flow, just in case some firms are cash constrained. And that doesn't affect the market to book value at all. And then we do it in changes, and we do four quarter changes just to make sure that there are no seasonality issues. And you see, we get a very similar result. We get 0.011 instead of 0.013. So this is what we're going to take as our baseline inverse psi. So this kind of says the psi is about 100. So it's certainly not costless, but it's not infinity either. So so it's there are these big adjustment costs, but they're not infinite adjustment costs. So the market to book value does seem to have some effect on investment. And then column 4, we just wanted to make sure that we were doing this as is the literature, and so we found this econometric paper, and they do this cumulant approach. So we thought we'd try that as well, and again you get very similar coefficient. So anyway, so we're going with column 3 as our baseline. So what we need now, the next ingredient to work out the aggregate effect is how much the trade war affected the market to book value. And once we have that, and then we know how much the market to book value affected the investment, then we're good to go, and then we can aggregate up to get the aggregate effects. So, but before we do that, we just wanted to do a reduced form where we just regress IK just directly on each of these components that we estimated, and controlling for cash flow. So here, this RC is the common factor. Here is the common effect, and D is the differential effect. This is just the idiosyncratic parts of the abnormal return. And then this R dot is what the return would have been on those non-trade days. So that's just the abnormal return. And so you see that all of them, well, the key ones that we're interested in, the common and the differential, are positive and significant, so both contributing to changes in investment. But for our baseline calculations, what we're going to do is use column 6. So here we're just regressing the change in the market to book value on all of these components. And as you see, so here, the ones controlling for cash flow, but these are all the components of the abnormal returns. And as you see, we can't really reject that they're not the same and that they're all around 1. So, I mean, they don't need to be, because, they could have different effects on the valuation effects. Like, it's not like, the market to book value has, the numerator and the denominator. So you have the, the share price changes, but you could also have this feedback effect that, people were talking about, that you could affect the valuation of the firm. And then here we just, we say, okay, this is just a confirmation that, if you just put in the abnormal return, they do affect the market to book value. So then if this is, without doing anything about our decomposition of the event. So if you think that, if you think that the trade war did affect stock prices, and that stock prices affect the market to book value, and then the market to book value affects investment, you can see clearly how this link comes through. Okay, so I think I'm doing very well with time, because this is my last slide. Huh?
Okay. Oh, perfect.
This is my last slide. Yeah. So then we just have the aggregate effect that we use, as I said, this column 6 for the effect of the delta, the RC and the RD on the market to book value. And then we use column 3 to see how then that translates from the market to book value to investment. And what we find, so we just look at the 4-quarter changes for 2019 and 2020. And so we see that by the end of 2020, there's, this additional effect of the 4-quarter change is 2.56, and, to give us a total change of 3.7. And, and then this could be split between the differential and the common effect, and the common effect, accounts for like the overall about 1/3 of the total. Okay, so I'm ready to conclude. So we developed a method of quantifying the impact of policy announcements on investment rates that makes use of the stock market data. And as I said, we are in progress of doing, right now we're just linking it to investment, but we're in the process of trying to put it in to look at the welfare effects, so that we not only look at what the effects are on the returns to capital, but also what the implications are for returns to labor and the overall aggregate effect. And we estimate here that this trade war lowered equity prices by 8.3%, which is about 2.3 trillion decline in the market value. And that, you know, over these 2 years, the fall in investment is about 3.7 percentage points. Okay. Thank you.
Thank you very much, Mary. So now, for the audience, feel free to raise your hand, and I will give you the mic as we go. I'm looking at it right now. That's right. So if you have any questions, I think Antoine, you just posted a question in the Q&A, so maybe you can address it to Mary. If Antoine has a mic.
Yes, can you hear me?
Yes.
Perfect.
Yes, thank you very much. I have a question. How could we account for the uncertainty nexus effect of tariff announcement on investment?
Sorry, I couldn't hear well. How can we count for what?
For the uncertainty nexus.
Oh, uncertainty. Yeah. Yes. Yes. So we haven't tried to separate the uncertainty effect from, you know, so it's not clear what it is about the trade announcements that maybe the effects. I mean, these are pretty large effects, and maybe they're large because there's so much uncertainty. But we didn't have a way of separating that from, you know, the actual tariff parts.
Okay, thank you, Antoine. Thank you, Mary. Mary, I have a couple of questions that are related. So you're looking at whether the firm is large or is an exporter or an importer. And probably more for being an exporter and importer, there is a degree of exposition. No, what is the market? What is the share of your revenue that is exposed to China, or that you're importing from China? It's not possible to look at this degree of exposure to the.
Yeah, so we started off thinking that's what we would do when we had higher hopes for what the data mine data was. So we, you know, because we thought like, because it had the, you know, industry affiliation, then we could, you know, and we know the sales of the firm, we could look at like import exposure and, you know, possibly use IO tables to then see, you know, what the input linkages are. But the problem is that for so many firms, the industry code was HS2 level rather than HS6, and then that mapped. If you try to do a mapping from HS2 to NAICS, then that's going to be, you know, very, very many of them. So essentially, we with the data we have, we didn't feel we could come up with a good measure of exposure. What we were going to do, which we're working on now, is to, like, we can definitely do exposure measures at the industry level, and so we thought we could look to see if the predicted effects on investment, you know, correlates with the industries where you would expect. But we didn't feel we could come up with a good enough measure for the firm level, unfortunately.
Oh, I see. That sort of answers my second question, whether the type of product that is hit by the tariffs, and if you look at whether they are homogeneous or differentiated products, whether we shouldn't expect some heterogeneity there, with homogeneous products in principle being easier to export or import from somewhere else,
right,
than differentiated products. But I guess you are stuck with the same problem.
Yeah, so you could do that again at the industry level. So, you know, as I said, we can do predicted effects of the stock returns and investments by industry. And then we can see in the industries that the goods are more differentiated or homogeneous or more, you know, have a higher import share exposure, whether you get the bigger effects there. But yeah, unfortunately, we can't do that at the firm level. At least I mean, you can try, but I just don't trust the measure that you would get in the end. Like, especially since, I mean, some of them have HS6, but a lot of them are just HS2, which I was very disappointed about, I can tell you.
Okay. So if someone else has a question, please feel free. If you cannot find the raise your hand button, please feel free to jump in. Otherwise, Mary, a last question from me. If you can tell us, you mentioned at the very beginning that you wanted to go from this impact on aggregate investment to welfare. Could you give us a flavor of what you guys are thinking of doing? How are you planning to do this?
Yeah, so what we're doing is we're taking a specific factors model. And so the specific factor here would be the capital. And, the idea is that, these firms have invested, in specific capital, and, that they can't just easily just move to another purpose. And one of the examples I used were, things like logistics, supply chains, they can't just instantly be moved. And then from a specific factors model, we should be able to have to be able to get then, once we can work out what the returns to the capitalists are, we have to go across all the firms and all the industries, then we can get implications for what happens to wages. Now, one of the, so we would get like the heterogeneous effects, the inequality effects. But one of the key challenges is that what happens to prices, expected price. So we have come up with a way, like kind of analogous to this, where we start off with like to see what happens to the expected inflation due to the trade war. So we have so if you take the yields on the inflation adjusted and the nominal, so the tips, you get the expected daily inflation. So we can do the same thing of like then regressing those on the treatment and the days of the trade war. But the one factor is that you might think, the difference between the inflation adjusted and the nominal may contain other things, not just expected inflation, but it may have something about liquidity risk or inflation risk. So fortunately, being at the Fed, one of my colleagues with Tobias Adrian have written a paper where they've decomposed all of those components into the inflation expectation parts and the other parts as well, the liquidity risk and I just mentioned. So we took that. Actually interesting. So we have already run this. We first of all just did the unadjusted one, and then we took the one by Tobias and Richard Crump and co-authors, and we got almost the same coefficients but much smaller standard errors. So that was kind of reassuring. And interestingly, we get that the trade war reduced the expected inflation. So we're thinking that might be due to I don't know, increasing the output gap, or like the people might be expecting a slowdown, and so that's going to be important to get the real return. So we're just getting all the different components, and we didn't quite have the model finished, ready for showtime, but that's basically the direction that we're going with.
Super clear, and I look forward to reading it.
We look forward to your feedback.
So if there are no further questions, let me thank you, Mary, for a brilliant presentation, a super interesting paper. And
thank you.
I'm sure we all look forward to read more about it. Before closing it, I have two announcements. The first one is that the seminar next week on December 7 of Laura Alfaro has been postponed to the spring. So it will be happening in the spring. There will be no seminar next week. And therefore, the next seminar of the series is going to be on Monday, December 14th by Dave Donaldson. So thank you all, and I look forward to see you back on the 14th. And Mary, thank you very much again.
Thank you. Bye.
Thanks, Mary. Bye-bye.
Thank you. Bye.
Bye.